Welcome to the Lazy Equity Podcast. Today we are going to be speaking about all things interest rates and the recent RBA announcements. And today in studio we've got Justin. Just thanks again for joining us, mate. Really appreciate you always coming back and giving your wise words to myself and the audience.
Yeah, amazing. Keen to jump into it.
Everybody's going around town at the moment, questioning what's next about the interest rates and how much they're going to drop, what this really means to sentiment inside the markets, and a little bit more about trying to actually understand them all. We know that historically and understandably why also, when interest rates drop, they become more accessible to more investors, or rather the funds become more accessible and palatable to more investors inside the property markets, whether they're buying their homes, whether they're buying their investments. And these are the types of things that drive demand inside areas. And I think we're going to unpack that a little bit today.
Yeah, definitely. You know, one of the crazy facts that people don't talk about is over the last 100 years, the average interest rate has been about 5%. So when people were buying properties at those 1-2% interest rates and thought they were going to ride that for the next 30 years, obviously it had to go to these highs, which it is now, to obviously start to drop back to that 5%. So that's why we say to people, you don't marry the interest rate, you marry the property. The property's not going anywhere. The interest rate is constantly moving. That's why just trying to time a market, trying to get in and out based on an interest rate isn't really a strategy when it comes to property, because unlike stocks where it's a liquid asset, you can get in and out really quickly. There's so many transaction fees with property. Yeah. Hence why trying to time an interest rate isn't really a strategy. And you just got to be ready to kind of ride that roller coaster. It's just the cost of doing business in real estate.
Yeah, I think, the sentiment of what we went through during that COVID time and post-COVID when there was a recovery, I think there's less of an education around why we actually had such low interest rates. There was the global economics, not just Australia, but we'll use Australia because that's what we're familiar with. We know that there was a large amount of money which was not being earned as much, and so there was a stimulation requirement because people needed to spend money through at least being tempted to spend money. And people being tempted to spend money is when things become available and cheaper to do so. So a reaction of what happened during that time was interest rates were dropped, which made things cheaper to buy and easier to borrow. And this then stimulated the economy because the economy wasn't moving in the general, usual way it was during COVID. So we need money movement in the country. We need a balance of money movement, let me put it that way rather. And that working of making those interest rates available and affordable and palatable to so many people is what grew that property market during those times, or the property markets rather at those times. Then what happened is that there was too much of that and there was an aggression, and this stimulated the property prices, which then people continued to still buy because, the values were there, but they were overspending. And that then created too much spend. And that's basically inflation. And that's what led to inflation. So we're at the stage where inflation comes into play. And as soon as inflation comes into play, the regulators need to then control that. And by doing a increase of interest rates every quarter, or it was quite often during those days, wasn't it? How often was it? I think it was maybe once a month.
Yeah, it was crazy. It was just
every other month almost.
Yeah.
And every time a new interest rate announcement was given to the public, there was a reason for that. And that was to slow down the spending slowly because we were getting too ambitious about spending and creating too much inflation inside our environment, to the point where we actually got up to a 6% rate. And that essentially slows down the spending. Exactly. So consumer price index is basically the cost of goods within an area, and there needs to be a balanced margin around that. And if we are spending too much, we need to then control that. And the easiest way to do that is from the RBA's increase of the interest rates. And what's the current cash rate at the moment?
Man, it's actually 3.6.
And loans are being sort of divvied out at around 5.4 to 5.8%. So at the moment, we are coming down from that 6%, which is great. And our recent last announcement was a drop of 25 basis points, which was passed on by the banks. And obviously that means that cash becomes cheaper then again to borrow 100%. And buy.
Just on inflation, something that I feel a lot of people don't know. In 1971, prior to that, we were on the gold standard. So there was only so much money in the economy compared to how much gold there is in the world. From 1971, moved away from the gold standard, meaning money is no longer backed by anything. From there, we can just keep on printing more and more money. When there's more of something, becomes less valuable. And this is why inflation has really started to take off. The value of money halves every 20 years. So $1,000 today, in 20 years' time, will only be worth what $500 today is. This is why cash is trash. If anything, to put that money into good quality assets, or even better, use the bank's cash. It's essentially the same thing. You take the bank's cash, put into good quality assets. Build your wealth, and over time, inflation is devaluing the debt as well. So this is why, as I said, it's the money's really in the assets, not really the cash itself.
Cash is trash. I like that. Yeah, I mean, it makes sense. You know, cash is going to be the movable value, where the asset is, if you put it into the right asset, obviously it's going to be appreciating.
Yeah, that's why they actually call it currency, because it's much like a current as it flows through a river or whatever it is. That's why they call it currency, because essentially it's meant to be moving through the economy, meant to be flowing. When you hold too much of it, that's what kind of makes it stagnant. So.
Didn't know that.
Yeah.
Interesting point. Well, here's another fun fact for you on the side. Apparently, and I saw this on social media, so don't take my gospel for it, but even though this is going to be on social media, but the silver consumption has increased significantly since this AI boom has started happening. And the expectation for it to become more used over the next 15 to 20 years is expected to outprice the value of gold by that time. And so if anybody looking to invest in anything outside of property, potentially silver might be a good opportunity. Again, have a look at it on your own a little bit more deeply and make your own assumptions and get your education around that. But just a side note.
God, it just shows that the power of investing in other assets. You know, 97% of the world's money now is just numbers on a computer screen. Since they're able to print more and more, there's just no more tangible money. If everybody went to the ATM, tried to pull it out, there's just not enough money there. It just shows how quickly the dollar's devaluing.
Yeah. Well, the world's full of debt. And it's literally just, again, numbers on the screen.
Yeah, it's done 1913 as well. So with that, I don't know if you heard this before. Prior to 1913, there was no Federal Reserve, JP Morgan, those type of guys want to create a centralized banking system. This is where it gets a bit crazy. Some people are against it. Those people were actually on the Titanic, which obviously hit an iceberg, sunk. From there, that's where JP Morgan.
Coincidence?
Yeah, JP Morgan actually owned the company that owned the Titanic.
I heard about this.
Yeah, crazy in that sense. So that's why we have a centralized banking system. And that's where it comes back to the sense that you always hear not enough money in the world to pay back the debt. Essentially what happens, Federal Reserve creates, say it's $1 billion, puts it into the world, then they charge interest on that. So the world has to pay back $1 billion plus interest. Not enough money to pay back the interest because they've only been given $1 billion. So therefore the Federal Reserve constantly keeps printing money, constantly keeps the world in debt. No, it sounds a little crazy, but that's actually how the Federal Reserve controls the money system.
That's amazing. I actually haven't really put it into a picture that way, but it makes so much sense for why inflation is a thing. Right? It's like, what is inflation?
And obviously these people that are obviously creating these laws and rules and new institutions and all that were the huge aristocrats. They owned a lot of the assets, they owned a lot of the land and all that, knowing that if they can introduce inflation, devalue the money, from there, their assets just going to keep growing at a rapid rate. And this is the power of being able to control real estate, be an owner, not a consumer.
100%. Puts it into a picture. I guess on that note, we also have to talk about the next rate announcement expectations from our side. Because of all this debt and because of all this inflation and because of all this money movement at the moment that's happening inside at least the Australian property markets, we are seeing an aggressive level of the interest inside the markets where we're buying. And this is then obviously growing the equity base, which is pushing up the value, and the value then continues to get purchased at higher margins, and therefore inflation becomes a thing, and that's why I guess we've got this numbers on a screen debt issue. But what's causing these numbers to increase so much, do you feel?
And there's a couple of things. Obviously, we've got 1,400 people a day coming into Australia. That's what we know of as well. It now takes longer to build a house than what it did 30 years ago. So I'm finishing off a subdivision project over in Perth, and I swear to God, I feel like I have to sell my kidney to get this across the line. It's just the amount of red tape we're going through. We cannot build enough housing for the amount of people moving in. And obviously, property is just about demand and supply. When there's just a lot more people moving in, this is just going to jack prices up a lot quicker. Emotion fuels markets as well. As we're seeing, a lot of people are knowing interest rates are coming down. The influx we had as well, everyone's trying to get in over the last couple of months, knowing interest rates going down, more people have access to money, it's going to shoot prices up.
100%.
Yeah.
I also do feel like there's going to be a little bit of a sense check on the next announcement. And I think we've heard this quite a bit through the news lately, especially, that the next announcement is probably going to be a hold. And that's just because of this inflation that we've been going through at the moment. There needs to be a bit more control around it. And I'm fine for it. the end of the day, we do want our rates to be as low as possible so that, we can save our money and not have to spend it so much. But the problem is when it is so low, you spend more and you spend it somewhere else anyway. And I think it's probably a good thing to hopefully see a bit of a hold on the next one. Ideally, we still want it to continue over the long term to go down. For investors that are going into this at the moment, going through a loan, I would say it's probably more beneficial for them to start looking at short-term fixed loans, potentially 1 year, because they are a lot lower than the other loans on the market at the moment that are variable. You're talking almost 1% in some cases. And if you can fix it for that term, we're probably not going to see a drop within 1 year or at least maybe even 2 years to that capacity, which is going to help that cash flow for that individual. So for those that are looking to take benefit at the moment of these interest rates, I would say because we're expecting a hold, have a look and have a conversation with brokers and your banks around going into fixed rates for a very short term and understand potentially how that will help you on your cash flow potential in the future.
I think just reiterates at the start as well, just trying to time interest rates isn't really a great strategy as well. Like obviously trying to capitalize, maximize as much as you can while you can, but the overall strategy should be kind of trying to grow a property portfolio as quick as possible. The best way to can do that is obviously just not just the growth, it's the compounding growth, holding it for years, be prepared to ride that roller coaster, factor it into your feasibilities before you go ahead. And that's where it grows, redraw the equity, get into the next one, really focus on that wealth creation before we start to focus on the cash flow. So
yeah, don't get too obsessed around the cash today. Understand the actual growth impact and equity creation and wealth creation into the future.
Yeah, exactly.
Often we see investors go into investments and they purchase these properties that aren't favorable for their personal wallet, and they are buying at an over-leveraged price point. But some of them are okay to do that because they understand that there is equity base, and the equity is really where you make your riches on the property. It's not around the cash flow today. Essentially, obviously, you want to retire on the cash flow and you want to make sure that the rental return will help you to do that. But also that rental return just needs to be there to service the bank today, or rather for the next property. Yeah. The real riches are made from the equity. And as soon as people can get comfortable with the fact that it's good debt and that you can repay it, obviously not putting yourself into a financial distressed situation is very important. But as soon as you can get around that comfort and you can understand how leveraging the equity against the higher value of the asset compared to what your actual installment of that investment costs you, your down payment essentially, and you get comfortable around that, that's when real success happens. And I think if you are strategic around that play, rather than, like you said, trying to gauge interest rates or work off a tax deduction or something like that, then you're going to be way better off.
Yeah, people say I'm going to wait till the interest rate goes down until I start to buy my property. And I'm just thinking, 15,264 suburbs in Australia, every single one of them is on a different property cycle. There's always money to be made somewhere. I think it's also something to be considerate when you're looking into an area, the debt to income ratios, how much debt compared to the income. This is why Perth skyrocketed, because their income levels weren't too much different to the eastern states, but as interest rates went up, it didn't make much of a difference in Perth, just because their debt levels are so low compared to their incomes.
Correct.
So as those interest rates are going up, they didn't care. Prices just skyrocketed, almost doubled in a few years as well.
Yeah.
So it is something to consider, the overall market, how their debt to income is. But yeah, just trying to use interest rates as a strategy, it's just, you're wasting so much time.
I couldn't say it better myself. Mate, thank you very much again for coming in. We always love having a bit of a yarn around the recent topics at the time for investment properties and for investors around Australia. Thanks again for listening into the Lazy Equity podcast. Until next time, make sure to like and subscribe.